SIP investing is meant to be simple, but I see people make the same mistakes over and over again, and that costs them serious amounts of money and returns. So in today's video, I'm going to break down the 5 biggest SIP blunders and how you can easily avoid them to make money work harder for you. Hello everyone, I'm Udayan Adhye and have been licensed in Indian financial services since 2015, first in insurance and then in mutual funds. And so far, I have helped over 1,500 families make better financial decisions. And here on my YouTube channel, I talk about all things money and personal development. Now let's get straight into mistake number 1. And for that, I'm going to ask you a very simple question. So let's say you're investing 10,000 per month through an SIP and have been investing for 5 years. So today you'd have invested a total of about 6 lakh rupees. Now how much would your investment value have to be after 5 years for you to be happy and satisfied with your investments? Option 1, 8.2 lakhs, option 2, 9.2 lakhs, and option 3, 12 lakh rupees. Take a moment, think about it, and be honest with your answer. Now, in option 1, you would have gotten a return of about 12%. In option 2, I have assumed a return of 14%. And in option 3, I have assumed a return of a massive 20%. Now, the reality is that the Indian stock market has typically returned between 12 and 14% annualized returns over the long run for an SIP investment. So, if you're expecting option C, that is 12 lakh rupees consistently, you are setting yourself up for disappointment and making the mistake of chasing unrealistic returns. And in fact, if you had 9.2 lakhs at the end of 5 years, it would have seemed like you're not really doing well. But in reality, you're actually performing superbly. And because it may seem like you're not doing well, it may discourage you and stop you from investing entirely. I see this happening all the time. So the first mistake is thinking that SIP investing will make you rich right away. Now, it's true that SIP investing can help you build massive wealth, but it takes time. And that happens by design just because of how SIPs work. Just think about it. If you have a 10,000 per month SIP and soon after you invest in the very first month, the stock market goes up by 10%, which is, by the way, very, very high for the market to return in just 1 month. But even if that happens, your investment of 10,000 would only grow by 1,000 rupees and now you'd have 11,000 rupees by the end of that month. So despite the stock market gaining by a very large number, the actual difference that it makes to your investments is very low. And this is in fact applicable to the first 3 to 4 years of investing, when even if the markets do really well, you won't be truly able to enjoy its benefits just because you don't have a high amount invested. So the difference that it would make to your life is negligible. Let me share an example of the Parag Parikh Flexi Cap. In fact, it's a star performer, a very popular fund. You can see in the past 3 years has generated a return of about 17.2%, which is fabulous. If you had an SIP in this, let's say for the past 3 years, how would your investment have looked like? So I'm on ticker tape, let me go down. So in the past 3 years, the Parag Parikh Flexi Cap here has returned 17.7% annualized returns. So if you had 10,000 invested every single month for 3 years, so you would have invested about 3.6 lakhs in total. And after taxes, if you had sold that investment, you would have only had 4.48 lakhs. That's a post-tax gain of less than 1 lakh rupees, and that may have seemed disheartening. But now I'll start increasing the number of years for which you'd have stayed invested for and kept your SIP on, and you'll see how the returns, they start changing. So there you go, right? After 5 years, you have invested 6 lakhs, you've made almost 5.5 lakhs. So your investment in a way has doubled in value. And this, by the way, is not a simulation. This is actually how the Parag Parikh Flexi Cap has performed. This is not a paid partnership. I'm just giving you an example. I'll be taking the names of a few funds as the video goes along, but all of those are only for educational purposes, so you understand the concepts well. When I say increase it to 10 years, that's when you see the real magic of SIPs, right? You have invested 12 lakhs, but now the total return of your investments is 21 lakhs, almost double. So you would have after taxes about 30 lakhs of value in your portfolio. So when you're investing in SIPs, don't expect big gains in the first 3 to 5 years and try to stay invested. Try to keep investing for at least 10 years to see its magic. Mistake number 2 is stopping your SIP investments when the stock market is very high. It's something that I get asked every single day, that should I stop my investments, SIPs right now because the market is so high? And a lot of people believe this is a good investing strategy. So let's look at a real life example from the 2008 financial crisis when the stock market crashed by almost 60%. And by looking at this long-term data, we'll actually see how investments would have performed if you just stopped your SIP before the market crashed. And I'll walk you through 4 different scenarios showing you how a 5,000 per month SIP would have played out depending on when you started it. In scenario 1, you started your SIP in January 2006, 2 years before the stock market crashed. In scenario 2, you started it in January 2007, 1 year before the crash. In scenario 3, you started it in January 2008, right as the crash started. And in scenario number 4, you started your SIP in March 2009 when the stock market had already collapsed and had started recovering. In scenario 1, you would have invested 11.3 lakhs in total, and by October 2024, it would have grown to 47.5 lakhs. That's an XIRR of 13.67%, which represents the annualized return. In scenario 2, you would have invested about 10.7 lakhs and it would have grown to 41.8 lakhs, which is an XIRR of 13.8%. In scenario 3, you would have invested a total of 10.1 lakhs and that would have grown to 37.6 lakhs, which is an XIRR of 14.2%. In scenario 4, you would have invested 9.35 lakhs and that would have grown to 31.73 lakhs, which is an XIRR of 14.39%. So what can you actually learn from this? Whether you started before the crash, during it, or right after, the long-term returns of an SIP are still very strong. Now, you may argue that the annual returns are almost 1% more if you started right after the crash at the lowest point. But think about it. How will you exactly know when the market is at its lowest point and has now started recovering? It's almost impossible, in fact, definitely impossible. And more importantly, focus on the final values in all these 4 scenarios. By investing about 2 more lakhs and by starting 2 years before the crash, you ended up with almost 16 lakhs higher. Now that only happened because when the market eventually recovered and started soaring, more of your money was invested and there was scope for higher compounding. That's why once again staying consistent with your SIPs regardless of market highs or lows is far more important than trying to time the market. In fact, if the market falls, it's actually beneficial to you as an SIP investor because now you're buying at lower prices. So eventually when the market would go up, your lower prices would compound to higher amounts. Mistake number 3 is chasing the best SIP date. Now, many investors believe that making your SIP investment on a particular date of the month can actually increase your returns. Is that true though? Let's look at a study by Zerodha where they looked at SIP performance across 3 different indices. The Nifty 100, which tracks India's 100 biggest stocks that are large cap stocks. The Nifty 150 mid cap index, which tracks the 150 medium sized stocks in India. And the Nifty large mid cap 250 index, which invests 50% of its money in large cap stocks and 50% in mid cap stocks. Here's what the study found. You'd first notice that the returns across the different dates are actually almost identical. If you look closer, you will notice that the 24th of every month seem to give the highest returns across all 3 indices. But before you rush to adjust your SIP date to the 24th, look closer. The difference in returns is minimal. For example, in the Nifty 100, the annual SIP returns range from 13.71% to 13.8%, which is a tiny difference of 0.09%. Even for mid caps, that difference is only 0.12. Just to put that in perspective, if you had invested 10,000 per month on the lowest return date in the Nifty 100, your investment would have become 94.12 lakhs in 18 years. While if you had invested on the highest return date, you would have had 95.17 lakhs, which is not a relatively high amount considering how much you have invested. So remember, there is no such thing as the best SIP date. In fact, you should set up your SIP in such a way that it gets deducted automatically within 2-3 days of you getting your salary. This way, you won't spend that money elsewhere and will stay consistent with your investments. Which brings me to mistake number 4, overcomplicating the frequency of SIPs. Now, a lot of people are confused about whether you should opt for a daily, weekly or monthly SIP. And it makes sense, right? Because if you have a more frequent SIP, like a daily or weekly SIP, you're able potentially to capture the movements of the stock market much better. But again, is that true? Now let's look at data, and this time we'll look at large caps, mid cap and small cap indices. As shown in this table, the returns across daily, weekly and monthly SIPs are virtually the same. In fact, the difference is less than 0.05%. across all the indices. That's why I follow the KISS principle, which is short for keep it simple, stupid. Stick to a monthly SIP. It's the most common across platforms, and that way once again your money gets deducted soon after you get your salary and you're less likely to spend it in other places. Mistake number 5 is underinvesting in SIPs. This is by far the most common mistake that I see people make. I have come across people who are earning 5 lakhs a month but are only investing 10,000 per month, or someone is earning 50,000 per month but is only investing 1,000 rupees per month. And I'm not at all making this up. Most people, from what I've noticed, underinvest money because they don't feel confident to invest. Somewhere deep down, they're truly afraid to invest higher amounts. And that's where I believe it is critical to start taking professional advice. Yes, there will be fee involved when you do that, but because you'd start investing much higher amounts, your returns would potentially be much more, and because you'd invest more, that fee would be marginal. A lot of people try to chase higher returns, but let me share my screen and actually show you how just investing higher amounts can lead to much higher money over a long period. So this is for various SIP amounts. You'll see the SIP amounts here, and you'll see the annual returns that investment has generated. This is for a 10-year period. So the way to read this table, it may seem complicated, is if you have a 10,000 per month SIP that grows at 8% annually for 10 years, that would grow to about 14.25 lakhs. If it grows at 10%, it would be 15.65 lakhs and so on. And you can see the various final amounts after 10 years for different SIP amounts for different returns. Here you would notice that if you have a 10,000 rupee SIP that grows at 16% annually, you'll have about 21 lakhs. But if you invest 15,000 rupees and that SIP grows at only 8%, then again you would have 21 odd lakhs. That is the difference that investing a higher amount can make. And here you will see I have made two cells of the same color to give you an idea as to how different amounts compare to different returns. One very staggering example is if you have a 15,000 rupee SIP which grows at 10%, you would have about 23.4 lakhs. Whereas if you're investing 10,000 rupees, for you to get about 23 lakhs, you would need an annual return of 18%. And what ends up happening is that when you start chasing 14, 16, 18 and 20% annual returns, you are more likely to make a lot of mistakes when it comes to investing. You may take on unnecessarily higher risk and you may not even get 16%. You may get significantly lower. So again, the magic pill to just getting higher returns, and this sounds absolutely dumb when I say it out loud, is to simply invest higher amounts. Try to invest as per your potential. And I'll share 3 useful ideas with you of how you can figure out how much to invest every single month. The easiest approach is a fixed percentage approach. So just simply decide on a percentage of your income that you want to invest. Say 10, 20, 30, 40, 50%. The beauty of this method is that it scales with your earnings. So even if you're starting out or you're relatively well established in your career, it still works. And the best part, it follows the golden principle of investing, which is pay yourself first. The second method is the leftover method, in which you invest what is left after all expenses. So in it, you will first figure out how much you're spending across various things: rent, bills, eating out, traveling, and then invest about 80 to 90% of what is left. Now, I personally don't really like this method because in it, as you can tell, investing becomes the last priority. And finally, strategy number 3 is a goal-based approach. So in it, you work backwards based on how much money you would need for various goals that you have. This can be super practical, and let me share my screen for that, where I have created an Excel sheet that you can access using the link below the like button. So in it, you would first put in how much money you would need for a particular goal that you have. So let's say you need 20 lakh rupees 7 years later for the down payment of a house. So I'll enter 20 lakhs here. I will enter how many years to go for that particular goal. Then at the same time, I'll enter the supposed inflation. So let's keep it at 10%. So 7 years later, what's important to understand here is that 20 lakhs will be worth 38.9 lakhs, which is a significantly higher amount. And in that case, if I'm assuming a 12% return on my investments, I will need to invest about 29,500 rupees. Now, in case I'm expecting 10% returns on my investments, that goes up to almost 32,000 rupees. Having shared these 3 techniques, always try to implement the Yerkes-Dodson law while investing. It's a very, very powerful mental framework based on research from 1908, which still holds true. This law suggests that a little bit of stress can actually improve performance, while too much stress can be harmful. And while I'm talking about the Yerkes-Dodson law with respect to investing, just think about it. It's actually true for all areas of life. So you have to find the right balance. So just push your comfort zone a little. If you're okay with investing 20,000 rupees, try to see if you can do 22 or 23,000, because that way, that new amount becomes the new normal, and within a few months, you'd barely notice that more money is now exiting your account. So remember, SIPs are a fantastic tool for long-term discipline investing. Don't overcomplicate them. And if you want to dive deeper into understanding mutual funds, then check out my course on the complete guide to mutual fund investing by using the link below the like button. You can pre-book it now at a special price. And if you enjoyed this video, then check this one out where I talk about SWPs, that are systematic withdrawal plans, where you can generate a regular income from your mutual funds. I'll see you around the next one.